Hi students, welcome to this first e-lecture on Final Accounts chapter adjustments. This e-lecture delivered by me, Raja, Chartered Accountant. Students, in this session we are going to cover what is Final Accounts, what are adjustments and adjustment entries, and how to pass adjustment entries for various adjustments. Let's get started. What is Final Accounts? So before answering that, let us answer ourselves a fundamental question as to why every company prepare accounts. See, the companies prepare accounts for one fundamental reason, that is to know whether they are making profit or suffering loss. And the other fundamental reason is to know what is their financial position. And how the company will get to know about this profit or loss and the financial position? Only when it prepare two statements. The statement 1 is called profit and loss account, and the statement 2 is called balance sheet. So the companies prepare accounts for two reasons. One is to know whether they are making profit or loss. The other one is to know their financial position, and that would be possible only if the company prepares a statement of P&L account and balance sheet. And when this P&L and balance sheet is prepared, it is after passing through various stages of accounting. So what are the stages of accounting? 1. The transaction takes place. That is number 1. From that, vouchers will be prepared. So that is number 2. From there, entries will be passed. That is number 3. Then postings in ledgers will take place. So that is number 4. 5. Trial balance will be prepared. That is number 5. And after this will come the important two set of accounts, namely the profit and loss account and balance sheet. These two set of accounts are prepared in the end. They are prepared finally. That's why these are all called final accounts. With preparation of P&L and balance sheet, the accounting cycle or accounting process of that particular year will get over, and the fresh set of accounts will have to be prepared for next year. That's why preparation of P&L and balance sheet is called as preparing final accounts. Next is what are adjustments and adjustment entries. Students, I'll give you one simple example. Just have a look at the example wherein you will have a P&L, and that P&L tells you the company has made a sales of 100 and there is an expense of 60 and the company has made a profit of 40. So 100 by 100, and this I would call a scenario 1, and I would give you another scenario, we'll call it as P&L 2. Here sales is same 100, expense I'm going to write it as 60 plus 20, which is 80, and profit is 20, and the total on both sides is 100. So now I'll give you this information. In scenario 1, the company has written expense as 60. It is because the company has also incurred some expense on salary to the extent of 20, but since the company has not paid the salary, it has not accounted, so it has written expense only as 60. Whereas in scenario 2, the company has not paid that salary, it is aware that it has incurred the expense on salary. So at any cost, this is an expense for the company. At any cost, it will reduce the profit of the company. So though the company has not paid that expense, it is conscious and it is aware that there is an expense on salary, it has been incurred, so it should be paid in future. So it is going to account it as an expense and it is reducing its profit. In scenario 1, the salary expense was not accounted, so profit was 40, whereas in scenario 2, Salary though not paid, since it was incurred, it is accounted, and expense was written as 80 instead of 60, and profit is shown as 20 instead of profit of 40. Students, now you answer yourself, which profit reflects the true financial position of the company? Is it profit in scenario 1 or is it profit in scenario 2? What are we interested about the profit? We want to know what is the true profit of the company. If we look at the P&L 1 scenario, the user of the financial statement will get misguided on looking at the profit of 40, whereas the actual profit of the company is only 20, because we know there is a salary of 20 which was not paid by the company. So real profit of the company is only 20. So the meaningful evaluation of scenario 1 and 2 will tell us the true and fair profit of the company is only scenario 2 profit, that is 20, and not scenario 1 profit. And how we got the true and fair profit in scenario 2? By making some adjustment in expense. What is the adjustment? We have added 20 rupees with the expense of 60, so that expense has become 80 against 60 in scenario 1. And this modification or this addition or this adjustment was possible by making adjustment to the final accounts by passing some entries which are called as adjustment entries. So student, understand the concept behind adjustment entries. Adjustment entries are those entries which are passed to bring out the true and fair view of the accounts of the company. Fine, we'll get started, or we'll see what are the various adjustment entries. See, on the screen you could see some 8 adjustment entries, starting from closing stock to interest on loan, and in the next screen you are going to see some another 6 adjustment entries. So this chapter on final accounts adjustment revolves around all these adjustment entries. We are going to see what is the effect of these adjustment entries, how it is going to figure in P&L, how it is going to figure in balance sheet. So it's going to be quite interesting chapter. We'll get started with each and every adjustments. Students, our first adjustment is closing stock. So to understand the concept very clearly, I have given the example to see what is the effect of this closing stock in the accounts. So just read the question. The value of closing stock shown outside the trial balance on 31/3/2014 is rupees 5 lakhs. So what is the impact of this adjustment? Like any accounting entry, adjustment entries will also have two effects. So one account should be debited, one should be credited. So what will be the effect of closing stock? We'll see. Closing stock, see first question, why closing stock is outside the trial balance? It's for simple reason, stocks requires valuation. So stocks should be valued. And what is the valuation for stock? Probably it would be advanced for you at this stage, but in your 1 mark question you would be writing stocks should be valued at cost or market price, whichever is lower. So this valuation has to be done. We have to see what is the cost price of the stock. We have to see what is the market price of the stock. And we have to select only the lowest of that value into the final accounts. And that would be possible only if this valuation is outside the trial balance. Okay. So in question, we always assume that the valued figure is given to us for answering. Okay. Yeah. So now we'll get started. So what is going to be the effect of this closing stock as an adjustment? We'll have it in next page. Students, closing stock will have two effects. The first effect will be in profit and loss account, or I would even say trading account. So the first effect will be on credit side of trading account. We'll write by closing stock. And what is the amount? The amount is 5 lakhs. And what is the another effect for this transaction? It's going to be on the balance sheet. Balance sheet on the asset side will write closing stock is 5 lakhs. So students, the effect of closing stock on accounts is it will find a place on the credit side of the trading account, and simultaneously it will find a place on the asset side of the balance sheet. So simple, the entry will be closing stock account debit. How much? 5 lakhs to trading account. Credit, which is another 5 lakhs. Students, now let me ask you a simple question. Why it is on the credit side and why it is on the asset side? Why closing stock, which is not an income, is shown on the credit side of trading account, and why a stock is shown on the asset side of the balance sheet? Students, for this we should go into the fundamentals of accountancy. Fundamentals of accountancy revolves around various concepts, and in that one of the important concept is matching concept. What does the matching concept says? Matching concept says all the incomes should be matched with the expenses. All the incomes should be matched with the expenses. What it has to do with the closing stock? Students, listen carefully. I'll give you a simple example. A company has purchased goods for 100 rupees. Okay, so it's purchases. So I'm preparing a small trading account now. A company purchased goods for 100 rupees. So it's purchases. Okay, and the company wants to sell entire 100 rupees worth of goods, but it couldn't. So out of 100, it has sold only 70 worth goods with a profit margin of 10 rupees. So it was sold at 80 rupees. So the company writes here, by sales 80 rupees. But when you look at the accounts, you have on the expense side purchases 100, on the income side sales 80. So it means the company has an expense of 100, sales of 80, there is a loss of 20. But your common sense says, no, there cannot be loss, because this guy has sold 70 rupees worth of goods with 10 rupees profit at 80. He has made actually a profit of how much? 10 rupees. But how can account show loss of 20? It is because what was happened is we have written entire purchases as expenses, whereas sales is only for how much? Sales is only for 70 rupees. 10 rupees is the profit. So the sales figure of 80 basically includes 70 plus 10. So what does it mean? Company out of 100 rupees, it has sold 70, still it has 30 on hand as stock. So if this 30 is subtracted from purchases, then on the debit side we'll have only 70, on credit side we'll have 80, so we can get the real profit of 10 rupees. So instead of subtracting from purchases of 100, we can write on the credit side by stock how much? It is 30. So now this question of loss is not going to arise, because now you have on the debit side 100, on the credit side we have 110. So 110 on credit side, 100 on debit side, so there is a profit of 10 rupees. So now it matches with our common sense. Our common sense said this company has made a profit of 10 rupees, but how come the accounts are showing a loss of 20? It's because the stock which was unsold was not accounted. Now we have accounted the unsold stock by following matching concept. So by writing the stock on credit side of P&L, we are not adding a new income. Actually, we are subtracting it from expense. We are not adding a new income. We are subtracting it from expense, so that we are comparing only the sales of that particular expense. When we are talking about sales of 80, we should compare its expense of 70 only. And how that was made possible? 100 minus 30, 70. So 70 is compared with 80. So we have a profit of 10. Fine. So it is for this reason this closing stock is shown on the credit side of the trading account. But next question is, why it is shown on the balance sheet? Yeah, we can understand the logic that it is reducing the expenses, so instead of subtracting we have shown it on credit side of P&L. But what is the logic in showing it in asset side as closing stock? Students, understand any expense which is going to give future benefit, any expense which will give future benefit will be called as asset, right? And any expense where the benefit will be consumed within 1 year, or I would say within accounting period, will be called as revenue expense. So in our example itself, the company has purchased goods for 100 rupees. Out of 100, 70 is consumed within the year. So this 70 is an expense, whereas 30 is not consumed. 30 will be consumed in future. So it will be sold in future. There will be a sale in future. There will be a profit in future. So this gives future benefit. So hence it is an asset. Any cash outflow, any expenditure which gives future benefit is an asset. So this 30 is an asset. So it is for that reason this 30 is shown on the asset side. Students, understand the logic behind the treatment. Don't go or don't get bogged down by the rule. Understand the logic. It is for this reason closing stock is shown as asset in the balance sheet.